So we have the privilege today of welcoming Dr. Johannes Lenhard, who's researching a book on the ethics of venture capital firms. Has been painstakingly conducting interviews with a very large number of venture capitalists. So I think we'll get some insight into how the industry works and how these organizations operate. Is that a fair summary, Johannes?
Yeah, absolutely. But let me say a little more about where I'm coming from to give a little bit more context of what it is that I'm doing. So I did an econ degree at one point and worked in business consulting. And from that moment onwards, actually, I had a summer job, or what started as a summer job and is continuing to this day for the last 9 years in the venture capital world, first in a CVC and then in a family office that only invests in new tech ventures. So I basically have this personal experience working in that world while I was doing my PhD. So after my consulting phase, I went and studied sociology, economic sociology at LSE. And for the last 8 years, I'm actually here at Cambridge, where I also spent a lockdown more or less randomly. And I did my PhD in anthropology, which sounds weird, but makes total sense if you think about the methods that anthropologists use. And that's really why I ended up in that discipline, because I'm completely free to do whatever I want. And actually, I'm encouraged to be as close as possible to what I'm researching at that particular point in time, to a point where I'm doing it myself. So that's how I ended up with this new research project. I'm following on from a PhD that I spent 2 years of in Paris, hanging out on the streets. So I researched how people sleeping rough around the Gare du Nord, so where everyone arrives with the Eurostar, how they survive. So in other words, my first book is on the economy of rough sleeping, homelessness in France. And that's a research strand that I'm continuing. I'm just in the process of doing a project on COVID and rough sleeping people here in the UK. While at the same time, for the last 3 years, my main focus was on talking to venture capital investors. And that, to set the stage in a sense before I'm opening my slides, has taken me from London, where I normally live, to Berlin. I am originally German, as you might have guessed, where I spent last summer, and I'm actually going back to next week to do more interviews and engage in as many activities as they are. And then I spent 6 months in Silicon Valley last summer. Actually, I was in Berlin 2 summers ago. And between these different locations, I've interviewed about 160 people, and I've had about 220 different interviews. And most of these people would be VCs, venture capital investors in early stage funds, or they themselves would be early stage investors in often setups where they would have different funds. But I'm focusing specifically on people doing early stage investing, and you'll see why that makes a difference in a second as well, possibly. And they would mostly be in commercial funds. What I mean by that is they would not be particularly focused on impact, on ESG, on anything that isn't really tech. I also have not spoken too much with biotech investors. So the proportion of the people that I spoke with is mostly focused on high-tech, new tech companies, and most of them actually on reasonably simple things. So not necessarily the deep tech end of the VC world. And I'm in the process, as Ryan said, of writing a book about this, focused to begin with on the very broad question of what do these people do, right? And now I want to start sharing my screen with you. And I think that matters quite a bit and is a question that we haven't looked at enough, definitely not enough, and in a sense, not at all. What do these people do in the whole world of technology, right? But let me start with what I want to talk about today when it comes to ethics. And what I mean by ethics is going to become clear even just from this slide. So when I say ethics, and I'm coming from a tradition that ultimately goes back to Aristotle and virtue ethics, Foucauldian ideas of working towards a good life with certain techniques of the selves, but we don't, for now at least, need to think about the theory behind this. What I really just mean is, how do these people make decisions? What are they motivated by? What is the structures that they're sitting in? Who are the different stakeholders in their day-to-day business that influence them to go in one or the other direction? So the starting question for my book is, I want to document the decision-making processes of these VCs. And again, this is mostly commercial VCs. And then in a second step, what I'm interested in is how that changes and what special cases there are. And that's where impact investing would come in, for instance, as well as, say, alternative approaches to venture capital investing, which might, for instance, be something that some of you know, indie VC. They just have a different model of doing VC, basically. And then another chapter is specifically focused on diversity and inclusion as one aspect, again, that isn't going particularly well for VCs. But my focus and what I mostly want to talk about today is the very simple question of, how do these people make decisions? We can get into the impact investing bit if that's of interest later, but for the next 10, 15 minutes, I want to squarely be in this bracket number one. And as I was alluding to, I think that matters, and this is controversial deliberately. I'm not saying that people shouldn't look at, particularly not in a group like this, the ethics of AI, but I think what we're often missing is these machines are made by people, all of these companies are run by people, these technologies are invented by people, and all of these people are ultimately dependent on these VCs, or most of them at least, when we're talking about tech companies today, right? There's this triangle of entrepreneur, investor, and the employee, which is what I think is much more important in a certain sense than looking at the ethics of a robot, right? If we don't get the ethics of the investor right, the ethics of the robot is always going to be slightly off, right? So I'm focusing again on this first bit, and very specifically because I believe in this idea of following the money on the investor and their decision making, because they ultimately are the funnel of what we will then have to deal with when it comes to the companies, technologies, and machines that are produced, at least again, if we talk about tech startups turning into big tech behemoths, right? All of these companies that we're dealing with on a day-to-day basis, don't need to tell you that, from Apple to Amazon to Google to Sun Microsystems, where VC backed. So understanding how these people take their investment decisions is key in terms of understanding how these companies come about. Very, very simple in a sense, my take on what VCs do, and then we go a little bit into what that means, what ethical questions it is that come up in this process. So some of you might have been familiar with the concept of blitzscaling, which we get back to several times during this talk, which I take, I think, completely uncontroversially as the kind of quintessential idea of how commercial VCs operate in this world at the moment. So to very quickly go through this, what I think is a 5-step process, VCs have to find these new companies. So this is on the left-hand side of the screen here. They do that through networking, mostly through warm introductions. They do consult with experts, have these first meetings with the entrepreneurial team, and then they go through a process they call due diligence, which basically just means they look at all the available data about that particular company. They have more meetings with the team. They speak to more experts about the market, possibly customers if they exist, and ultimately have to decide on a very simple yes or no basis, do we want to invest in that company at that specific, at these specific terms or not, right? And that's when the deal happens. And in the second step, and that second step in lots of senses conditions the first, they need to grow these companies, right? The VC is really very good at providing companies with money to blitzscale, right? And that just means nothing but grow very quickly, right? And in the end, what VCs work towards is nothing but an exit that can really only come in the form of 2.5 different steps. One is an IPO, the other one is a sale or a secondary, but that's not an option for everyone, depending on how big you are. Because the VCs as such, they're also called GPs, general partners, are dependent on capital that is provided to them. So they're not actually investing mostly their own capital. They might have been bought into a fund, but they're investing mostly LPs capital, limited partners. And that would be, in the US context, university endowments, foundations, family offices, high net worth individuals, pension funds. Very similar here, just with slightly more regulatory restrictions. So their business model is fully dependent on raising money from somebody else, these LPs, to then invest. And this cycle is from raising a fund and having to come to a point where they make financial returns is only about 8 to 12 years. Right? So obviously much more long-term than a stock market trade, but still for lots of companies that say are in a deep tech world or in a biotech world, not nearly long enough to really come to a point where these companies would be able to IPO sensibly. And one of the interviewees that I spoke with, who is a partner in London, he made it very clear to me what it is that within this process and with these different steps, what they have to be after, right? It's really just money. They have to generate these returns. And the attraction of the asset class as such, also for the LPs, is that you have the opportunity to find absolutely outsized returns. And we're talking about 10, 15, 100x within a decade, rather than 1x, 2x, 2.5x. Private equity is closer to 2 to 4x. And if you're an LP in Sequoia or Greylock, like big American VCs, you have at least some of their funds would have outperformed that in multiple times, right? So Sam, these are all anonymous names whenever I do use a name. He very bluntly told me, yeah, I mean, this is my job. This is what I have to do. I have to generate the biggest possible returns. And this, again, at the moment happens mostly by finding these companies that they can blitz scale as quickly as possible and take to some kind of an exit event in the form of an IPO or sale. And now I think there's questions. I'm actually going back. Reid Hoffman, who's the author of Blitzscaling and possibly more well known to most of us, not necessarily as a VC. He's one of the partners at Greylock in Silicon Valley, but as one of the founders of LinkedIn. And before that, he was part of the quote unquote PayPal mafia. And he wrote this book, Blitzscaling, which again, I take as one of the quintessential expressions of how commercial VC works these days. And he himself poses this conundrum towards the end of his book and talks about this is now mostly the tech company, but I take this also to mean the investor that supports these tech companies, right? So the whole book is about how companies can blitzscale, i.e. grow as quickly as possible, reach a certain scale, and ultimately raise another round / find an exit event in the form of an IPO. And he himself says, but you can't do that at any cost, right? You can do that at a lot of costs. You can be, and this is his words, a temporary pirate. You can break some laws, you can break some rules, but you have to have a very clear line of not becoming a psychopath. So fraud and lies, you have to be careful with your company culture, sexual harassment, and he is pointing specifically and explicitly at one company, which just happened not to be a Greylock portfolio company, Uber, which went too far, right? So he saw, he's trying to kind of have his own back, I think, by saying, look, you can go to a certain extent, but you have to have a stop sign here, right? And this is where I find it highly interesting to go in and say, and why is Uber not fine, but why is Airbnb fine, or why is Facebook fine? The answer is often, oh, Facebook, we couldn't know what influence they might have on, say, elections or spreading fake news or misinformation at the time when these decisions were taken. And that's exactly, I think that's wrong. to the extent that values, company culture, they don't start when the company is big, they start much earlier. And the investors often double up as board members, and they are partly at least responsible for this very early seeding of how the company is looking like in 20 years. Right? And we come back to that in a second, what I think the VC can, and in my opinion, really has a responsibility to do to prevent this switch to a psychopath, however you define that. Right? And here is some examples that I think are highly interesting as talking points, and again, very happy to come back to any of them later, where these are all VC-backed companies, most of them very well known, some of them dead, where what I would call ethical problems occur / continue to occur with consequences, right? And that's when it gets interesting for the VC. The VC as such, again, remember the quote that I showed you in the beginning, ultimately has a fiduciary duty, so they're bound by law, in other words, to make money for their investors, in brackets, at almost any cost. Right? And that's why this whole idea of ethics is so complicated for them, as a kind of almost something that they have to work against, right? But what they do understand is if you're unethical or if you take decisions, and again, I come back to what I mean by ethics for the venture capital investors at the end of my presentation, I believe that there is possible financial problems that you're running into. Again, let's actually take the most straightforward example, Uber. Uber made lots of money for lots of VCs, don't get me wrong, but it's a good example also where lots of VCs or investors more broadly lost money. So SoftBank, who hasn't been doing well in quite a few different areas, they're still sitting on a loss of several dozen million when it comes to their Uber shares. And I think that's not just because of their bad investment strategy as such, but because of bad management of the company, right? And this is again something that the early stage investors could have worked against by being stricter board members, by possibly not even investing, right? And that's what we're getting with it in a second. So I wanted to show 3 different problems here where I think the investor, stepping back out of the thicket of different examples, where investors in general terms are taking decisions, and I think these are ethical decisions that have consequences for the company, but also for themselves, and are not neutral, right? Which is also the descriptor for what I used here in this first line. If you think about how investment decisions are taken, and I'm now thinking early stage startup comes to pitch to the investor, first and foremost, what do you think is that the investor decides on if, say, this company is pre-product, pre-revenue? It's basically a team of 2 nerds from Stanford that came up with this idea during their PhD, which is exactly how Google happened. How do you invest into this company if there is no data, right? We are talking about a world, at least initially, where you can't run a model. There's no revenue projections. You don't even have the revenue of this month or last month. There's lots of bias and there's lots of emotionality happening here. Laura Kwang from HBS, she published lots on the impact that gut feeling has specifically for VC investors. And I believe from what I've seen in all of these interviews, quite a few of these investors admit that quite openly. They say this is, yes, we're looking at all of these different things. We're looking at the CV, we're talking to former colleagues and bosses of these different people, we're looking at the market, but in the end, my decision is not based on that. My decision is based on my initial reaction, my initial excitement, which is a word that I found reoccurring a lot in my interviews with what drives you to make an investment decision, rather than the data. I always see the data, and I said this second process, the due diligence process, comes after the first or second or third meeting. The data can prevent you from making a decision, but it cannot make you take this decision. The decision is based on your feeling and which often obviously is biased, right? That takes us to a point where the VC world, as it is made up of, in the partner level, about 88% men, reproduces this bias, right? And that takes us to the second line here. There's from the beginning of how companies are sourced, and by the way, also how VC investors themselves are recruited into this industry, has for the longest time not been a straightforward development path into this. Most of the adverts actually for VC company positions, and this is slowly changing, but most of them are not public. They are distributed through your own network. And a friend of a friend is then normally the person that you end up hiring, often through something like a college network, right? In the US, I think 50% of all the VC partners come from 3 different schools, and that's Harvard, Stanford, and Chicago, if I'm not mistaken. But the same happens with the companies, right? The companies that you're talking to are put in front of you normally through your network. You meet them through your network, sometimes at conferences, but that's much more unlikely than the company being sent, or the company's tech being sent to you by somebody that you know, possibly another investor, possibly an angel that you're working with, but these are all pre-existing networks that you're already part in, i.e., in the end, because of your field of vision being reasonably small, you're going to reproduce a system that you're in already. And again, this is most importantly happening for the tech companies that these investors invest in, but it also happens for the VCs, which brought us to this point where the diversity and inclusion statistics of VCs are much worse, for instance, than in banking. And even more so, and I said that to you before, which is why I always say, I think the quintessential one-word description of what VCs do is investing in blitz-scaled companies, or blitz-scalable companies, really. Is they only look at specific companies. They only look at companies that they know from the moment they invest in, say a Series A investor, they have about 6 years until that company has reached a scale and an amount of revenue that they can either be prominently placed as a sale for one of the big tech companies or IPO'd. And this excludes all kinds of businesses, right? And that's, for instance, where an organization like IndieVC comes in and says, actually, what's much better is if we, as a very early investor, come in and give you $1 million or 500K or 2 million, and after that, you manage to become profitable. Why would you give up equity, dilute your own ownership of your own company just to scale more quickly, right? This is not necessarily a sustainable effort. And again, I'm coming back to this specific word in a second. And ultimately, this is just what the investors want. This is not necessarily healthy for the company. So here are 3 problems that I'd say are built into the VC system as it stands at the moment, so that you basically have a bias in terms of who you're giving money to. You have a bias in terms of which companies you're funding, and you're reproducing a highly unequitable system, both in terms of who the investors are, and that obviously has direct consequences given the system as it stands, based on its warm introductions, on who you're funding. Now I want to not just leave you with, this is all crap. I think there is some movements happening, and these are not the only ones, the only things that are driving change in this world, right? I already mentioned IndieVC, which is something that I've only recently focused a little bit more on, and there's different efforts in that direction of finding an alternative commercial model. For instance, the Atomico Angel Program could be seen as something like that as well. But here's 4 big societal pushes that I think are reasonably new. And we're talking the last 5 years. And just for reference, the VC industry was officially born with the first VC structured in the same way that it still is, as an LPGP setup in about the 1950s. And there's a great new book that came out late last year by Thomas Nichols from Harvard University called VC in American History that documents that very interestingly. But to come back to now, I think there's 4 movements at least, if not more, and I see this in a wider framework of stakeholders that are pushing for a change from different directions. And one of them is consumers. I think the next generation in particular, and we saw that massively last year with the Greta Thunberg-driven climate change protests, basically. They are more attuned to sustainability, to climate, to an ethical consumption in all kinds of different spheres. And I think some of the investors that are not VCs, and also some VCs, they're already seeing that by putting up funds that are specifically focused on this type of new consumer. Right? So there's a push that ultimately is just going to create a new market, I believe. We're already seeing startups going into that sphere driven by consumers. And at the same time, what we've been seeing for the last perhaps 5 years is government regulatory clampdowns on, first and foremost, big tech companies, right? And in the end, what I'm arguing is that all of this creates pushes onto the investors as well, because what they are doing is ultimately invest today in what can make money in 10 years or 8 years, right? So these movements are important, even though they're not directly necessarily impacting the investor as such, but the companies that they're investing in. We've seen lots of different, just recently, obviously, as well, and continuing, just the Apple story from the last couple of days might also again spur some kind of a government action when it comes to antitrust. But Facebook has been fined many times. Google, we're having the GDPR that was introduced 2.5 years ago. California is copying a similar law. So there's all kinds of new regulatory frameworks put in place that are curbing the kind of widespread influence that tech companies have on different spheres of our lives. And I would say, as the state is able to understand more what these influences really are. And I think this is only going to become bigger and more important than anything else. So in a sense, the company that is winning the next, or is going to be the next unicorn, will have to deal with a possibly already slightly different regulatory structure that they're going into. And I'm also, without talking too much about that now, seeing similar things when it comes to the employees. There's a different, as the consumer changes, the employees changing, they have a different idea of what they want from a company. Google being a good example. Facebook recently has seen at least a wave of employees speaking up against some of their policies. So there's push from inside, I would call it, as well. And then another sphere that I've been looking at more and more, interviewing LPs, specifically in the US, there's a certain sensitivity among LPs whose investment horizon is much longer, we're talking centuries, right? Of having a slow but very deliberate change in, for instance, areas like diversity and inclusion. Spoken to several American LPs that are very, very deliberately making their GPs, so their VCs, but also other investors, for instance, report on diversity and inclusion figures, both on the fund level, so for themselves, but also on the company level. And that, I think, is a good first step to say, oh, wait, we have an issue here that we need to do something about. There's only one area where LPs are definitely driving some change. And ultimately, I think there's 4 things that are at stake also when it comes to the VC, and obviously, again, through the companies that they're supporting, driven by these 4 different forces. And now, for the last 2-3 minutes, I want to briefly talk about what exactly the VC is doing in all of this, and where, just to make this explicit again, the VC has an influence in this, what is normally what we're focusing on, company life cycle, and in a sense, in parallel, the investment life cycle, right? If you remember, this is similar to the chart I showed, where I mapped what the VC does in its process of investing and then selling the company. And I'm just pointing out 4 different bits here, and we're going back to the ethical due diligence as something that my non-academic self, I'm quite keen on actually talking to investors of what they can immediately do. And I saw that Susan was here as well. She's working on something similar to alleviate some of these problems, but that's what I'm going to end with. So forget the ethical due diligence to begin with, but VCs have a role in these companies, and they're particularly strategic directions, right? They are strategic advisors from the beginning. They're sounding board in an ideal case, and this was, by the way, also the case for somebody like Roger McNamee at Facebook. He was one of the most important people that Zuckerberg spoke with over years, right? He did definitely have an impact of what was going on in the early culture building at Facebook, right? And in a similar sense, VCs have very legal power as board members. Often the lead investors of every round will join the board, right? And that's ultimately, for those of you who don't know that bit of the Uber story, that's ultimately how Travis was forced out, because Bill Gurley, the benchmark investor who led the Series A in Uber, was quite suspicious of some of the practices that Travis was employing at Uber from the very beginning, but he didn't have enough power. And again, this shows you the VC does have power, but it's definitely limited structurally, right? If you're the only VC in a Series A round who is on the board, you will have yourself possibly facing 3 other board members that are nominated by the company. So Bill Gurley had to wait until a later round. I think it was after they raised their Series E, and there were enough non-company, non-Travis aligned board members on board until they could force him out, right? But there was a very specific, they were able to do that as investors that thought that the company was going in the wrong direction, right? But they had to wait to a certain point. Right? And another thing that VCs could, in my opinion, do slightly more is actually be patient capital, right? Why is it that there's an 8 to, and this is possibly even getting shorter, there's a 6 to 12 year fund life cycle? Why can't that be, why can't we come up with a different model? And that, by the way, already exists. It's called an evergreen fund, where you basically never raise one fund, you continuously raise money, and you can pay out LPs as you basically generate revenue. But most VCs are on the raising one fund, and then after 8 years, 6 years, however much they want to stay with them, raising another fund. Why is that the model? If that produces these blitz-scaled monster companies that can't, and I'm not blaming them at all times, that can't take care of everything, right? Why is there no role for an even more patient investor, even more patient capital to be played in producing these companies that think more, right? And that takes me to my last point I want to make, the ethical due diligence. As I said in the beginning, my philosophical understanding of what ethics is, and that takes us full circle, goes back to very simple virtue ethics approaches that in the end ask nothing but what is the good life that you want to lead, right? And how do you get there? And that sounds a bit weird to be applied to a company context, but I think they're ultimately doing exactly the same, and the VC investor does exactly the same, right? I translate this as, what is the goal you want to reach, and what instruments and tools do you apply to get there, right? And I think the most important starting point is, and this is why I would anchor this in the due diligence process, is reflection, asking these questions, right? I'm not saying you have to have a checklist, which, by the way, I don't think works at all, ever, of ticking a box ticking exercise of this is good and this is bad, right? I'm not necessarily interested in a value judgment that is put against a universal idea of what is good and bad. I think what we can do as a VC investor, and what possibly they all should do, is ask 2 very simple questions. One is about the internal buildup of the company, right? This whole idea of the blitz-scale company. Is this actually sustainable? Are they thinking about values? Are they thinking about culture? Do they have an HR department, which Uber, by the way, didn't have for the most time? Do they think about diversity? Do they think about work-life balance, right? All of these things, if you ask these questions already in an early due diligence process, you ultimately also position yourself as the advisor that wants to be there to help the CEO, the COO, whoever is taking charge of this, to figure this out, because nobody of these people necessarily knows that in the beginning, but asking as early as possible, I think, is a good starting point. And the second question for me is about the broader impact on society, right? I'm not necessarily blaming a company like Uber that they deliberately did this. I think to a certain extent, yes, breaking laws and breaking rules, and not thinking about the employees that they to this day don't accept as such. But I think, again, the role of the investor can be, is this something that you do think about, right? How do you impact your other stakeholders? How do you impact the environment? How do you impact your employees? What do you do in terms of alleviating that? And that's, I think, a very simple starting point for any VC. And don't get me wrong, some commercial VCs do this. They wouldn't call it ethical due diligence, but lots don't, right? And that, I think, is a function of the system that they're currently in, which is a very specific structure of an LP-GP dynamic, where the LP demands returns, and they're, particularly in the current environment of low interest rates, very much looking at the VC that is at least providing the opportunity to generate these massively outsized returns. So the LPs demand returns from the GP, and they ultimately have to do anything to get there, right? To produce these returns within the life cycle of the fund, because if they don't produce these returns, they can't raise another fund. And that means ultimately their VC career in this specific context doesn't work out, right? So in the end, I think there needs to be a shift in the systematic buildup of the system. But there is certain bits that the VC can already do in order to alleviate certain impacts that both the company has internally, but also externally. And that's, I think, what I want to end with, particularly again, thinking about the different pushes from different sides that I've been describing. I think we will see more of more consideration on the company side, on the ultimately investor side for certain ones of these. What you then could call impacts or impact investing, what at the moment is often classed as impact investing also in the VC world, where the impact on society, if even somebody like Larry Fink from BlackRock, who said that, I think last year, is something that you have to consider. You have to consider who the new consumer is. You have to go from shareholder to stakeholder capitalism, right? And I think VCs are, interestingly enough, despite their progressive attitude towards life, not quite there yet. And that's actually a puzzle that I'm trying to figure out the more interviews I do. Thank you so much for your attention, and I'm looking forward to chatting as much as possible. Let me right, yeah. So the question is, all of these appear to be externally driven. What would be interesting? Are you aware of any internal procedures being brought? So given the potentially closed structure of VCs, doesn't this translate into dominant ethics driven by people populated for those three schools? Actually, could you, Pierrot, could you explain a little bit more what you mean?
Yeah, so the first question really was in response to your slide that showed, externally all these companies had been fined and whatever, but that really isn't a measure of ethics, is it? That's a measure of them being legal, illegal, and there will be an ethical dimension there, but it's not necessarily pure ethics. So how far do these companies actually follow ethics internally? That's, I think, what was interesting to me is like, well, that's fine, but are you aware, are they ethically internally, or are they just trying to be legal? The second thing is, when you talked about these closed structure, the kind of the social structure of these VCs, is this like just a particular strata of American society that's kind of driving these VCs, and therefore their ethics that are disproportionately being potentially projected, because now they run these huge companies like Facebook and Google that are controlling the media to some degree, Twitter, and so how far are those ethics of this potentially waspish American society being projected globally?
Yeah, absolutely. Yeah, great questions. The internal structures, let me think about this. So I think I was trying to look at what drives these ethics from all kinds of different strata, because I saw that internally, and that's in a sense, in a nutshell, what I thought this quote was giving away. Internally, these VCs see themselves, and some of this is kind of hiding behind it as well, as driven totally by a profit motive, right? This is obviously not true, because again, as I showed, or as I claimed at least, I didn't show it, lots of the decisions that they make don't necessarily have anything to do with profit. They have to do with who they know, they have to do with who they like, they have to do with a gut feeling that, yes, might be driven by experience that in the end is fed by, oh, this has worked in the past, this should work in the future again. But the internal ethics in the sense of the VC is defined, their motivational structures is defined in a lot of ways by this LP, GP, we have to pay them back in X amount of years, profit-making capacity that they're ultimately hired to work towards, right? And I'm complicating this because I think on the one hand, there's very individual values, value systems, if you want to call that ethics, moralities driving an individual VC investors. Some of them might say, oh yeah, great, we could have made shit tons of money with Joule, but we didn't, because I already saw that or we had them there and they wanted us to invest. I have a very specific example that I'm thinking about now, a Valley investor, but we didn't do that because we had ethical quandaries when it comes to already being able to see that this is going to be sold to kids, basically, right? But the internal structure, that's how I would say, of the VC ecosystem basically pushes them to go, and I think that's why I always use this one-way description of it, into the most effective way of making as much money as possible. And that's what I think they figured out with the blitz scaling.
Yeah, I mean, to me, it kind of, that kind of makes sense, I suppose. But at the same time, ethically, I mean, potentially especially with your later slides with stakeholder economy, etc., potentially that whole VC model, blitz scaling, may actually break down as people decide, actually, I want to be ethical, I want to be, powerful, I want to be much smaller, though I don't want to be beholden to a VC, potentially. And I think that's going to be interesting to see how that.
Yeah, exactly. And that's exactly what I'm trying to, so thinking in my framework of what I'm trying to do first is show the world. There's not really, I was discussing that yesterday with someone, there's not really a book that just documents what these VCs are doing. So I'm trying to, and again, one word description would be they're investing in blitz scaled early stage companies. I'm trying to document these practices and in a sense set up the kind of commercial VCs ethical framework, motivational framework. And then I'm trying to document, and this is what's changing at the moment, right? And I think you're absolutely right. There is pushes, and this is mostly to begin with from the outside, to do something differently, right? So absolutely, but again, what has puzzled me is that it hasn't necessarily arrived in an internal change yet to the VC model as such. Yeah. And to your second question, yeah, that's exactly the problem of diversity and inclusion in this whole industry, right? There is an overwhelmingly white male Stanford, Harvard culture that has over decades completely dominated this ecosystem and is again still reproducing itself over and over. So to give you one example, in Britain, they have an okay idea of how many women and men and people of color are currently in which positions, at least for the last 5 years. Since they first measured it properly, which was 4 years ago, there's not a single percentage change in terms of the number of women that are in partner positions, right? That's how slow this industry is. So I think you're absolutely right. There's a reproduction of a specific type of mostly American, and that's then also swapping over as most of the capital is still there. But fortunately, and again, this is something I want to talk about in the second half of my book, there is European counterweight. So Atomico, at least Atomico positioned itself as a VC that has lots of capital, right? So they have market power as purpose-driven and much more, and I can see that in some of their actions quite directly, much more driven by, for instance, the diversity and inclusion agenda. Give you one example, Sophia Benz, who's one of the earlier female partners at Atomico, she runs their angel program, and they have 2 cohorts of angels in place at the moment. So they have about 20 angels, 30 possibly, and over 40% of them are not white, and over 60% of them are women. So that's basically the opposite of what the normal VC structure looks like. And even on top of that, none of these people have had exit events. So she gave money into the hands of people that wouldn't have been able to write angel tickets without that, right? So it's a very different approach that we do see in some bits and pieces coming up. And Atomico is highly successful, so I can see that more and more people will copy something like that. But again, yes, the dominant structure is driven by a specific type of, I would go as far as to say libertarian, the PayPal mafia being the most vocal kind of group that stands for these values, waspy, Stanford, Harvard educated white man, absolutely. Yeah. And that is definitely causing some of the problems that I described. Right?
Can I just follow on with what I'm saying? Do you think, in fact, that the rise of things like diversity and inclusion has driven these white males into doing things like becoming VCs potentially, as the rest of public corporations and government have become potentially more equitable? Do you think this is where they found themselves, or this is something that's not a product of that?
No, I don't think, because if you look at the industry's starting points right there, and this is an industry that hasn't existed in the UK until about 20 years ago, Germany possibly, around the dot-com bubble, they had first outlets here as well. So it's an American industry to begin with. And what it started with initially was actually, in a sense, overgrowing family offices from people like the Rockefellers, right? So these were all rich industrialists that started investing money into early stage ventures. And that's actually what one of the first VCs that's still in existence grew out of, called Benrock. And then we have a little bit of a different kind that came out of elite universities. So Doriot is, the general is often called kind of the inventor of VC. And he was supposedly at least reasonably sexist and possibly even racist, and often recruited his own kind and gave money to his own kind, i.e. to people that he taught at Harvard. So there's a very strong sense that this type of person was running the VC world from the very beginning. Rich, white, highly educated man. So I don't think that's at all. If anything, I think this movement is sweeping across the VC industry at the moment. And again, now, if you look at VC Twitter stuff at the moment, there's so much happening when it comes to actually recruiting. The claim is hire and wire, right? So hire people of color and give money to people of color. And there's big funds that are making steps in that direction. So I think that there's change happening there, if anything, in the direction of more diversity and inclusion from a position that historically has been terrifically bad. Great. And then we had a question by, Alejandro, did you want to, your question was, what are your thoughts of the newer VC approach which organizations like EF or YC have, where they come in on the earliest stage but continue joining rounds of later stages? Do they fit the same point structure discussed? Yeah, so the question is whether YC specifically, actually, and I would say EF is a possibly, I really like Matt actually, but I think EF is a reasonably a copycat of YC with a slight European angle, but they're doing something very similar. And I think what they're doing is actually not necessarily producing good companies. What they're really doing is positioning people that they think could be successful in raising money in front of the right people. So if you're looking at what YC has turned into, I don't know whether that was fundamentally different 10, 15 years ago, but what's really happening now is not necessarily that you produce sustainable companies, but that you produce companies that can raise around. And they're very good at that. And some of that might come with producing companies that become good companies in the ethical sense of the word, but lots of it is not necessarily at all about that, right? So I wouldn't class YC specifically, and to a certain extent EF, as a different type of VC approach in what they're doing. In fact, they're working, I mean, this is being very critical, but they're working within the VC ecosystem as part of kind of playing into the VC's hands and getting a little bit of a dividend in the process of that.
Mm-hmm. That's really interesting. That's a really interesting perspective. And I guess, yeah, I have like two questions on that. The first one is, I guess the first one is less related because I'm curious about the regulatory frameworks and your thoughts on how they can play here. But specifically in regards to the point that you just made, you've mentioned that there are, some good things, both historically and presently around the VC stuff, and there's some bad things. Specifically in this movement that are coming in, there's sort of new VCs like, Entrepreneur First, but others like, Founders Factory, etc. Would those initiatives help bring more positive change towards where you're mentioning it should go, or do you think this is actually enforcing the bad of the existing VC industry? And the reason why I ask is because that's really interesting point you mentioned in regards to the playing within what makes VCs actually be bought in, whilst at the same time, putting quite a lot of emphasis on this sort of all of those buzzwords like defensible tech and et cetera, et cetera. But yeah, it'd be interesting to see, like, do you think that enforces more of the positive or the negative of the VC in the medium and long term?
So briefly talking about EF, which I've been to several of their demo days, and one thing that impresses me about them, which has gone in the opposite direction with YC, which I've been following for a while, is that they are bringing other companies to the table, right? So positive thing about EF, I believe, is that they are very focused on making or helping people to become entrepreneurs. And I think their program, or their educational program that the company is, quote unquote, I mean, to begin with, it's really just individual, well done. And they're turning people or supporting people to turn into entrepreneurs that wouldn't have normally become entrepreneurs. And these are often people that are academics, and that usually are academics that have done something that's helpful. So scientists, not me. And that's good because they are often highly risk averse. They don't have a route into, I mean, if you, for lack of a better word, commercializing the kind of findings that they made in, say, their PhD or postdoc. And EF is very, very good at teasing these people out, giving them a kind of stable setup where they can try out themselves, and then helping them to actually build something. Find the right people to do that with, and then build something that can possibly have a good impact in the world. How do they do that, however, is very much, again, within prevalent structures of what VCs would do as well. If you look at who is joining EF, Oxbridge people, like the overwhelming amount of people that come with kind of the brain and are not the developers, so to speak. They often do a good balance between, look, here's some engineering talent, some developing talent that have worked at Facebook, Google, whatever, and want to start their own company. But the people that come with the brain and did their PhD with Stephen Hawkins, they all come from Oxbridge. So they're not necessarily, and that might be complicated, don't get me wrong, I haven't seen their application pool, but they're not explicitly, or at least not in their effects that they're having, working against, say, a very elitist reproduction of the system. Right? So in that respect, there's problems within an EF ecosystem. And YC, in a sense, is slightly different in that YC is they're giving these green cards out to people that are university dropouts, right? There is this slightly more American idea of we can't quite, I mean, you have a good idea, it doesn't really matter who you are. EF definitely doesn't do that. There's no even just a hint of that in EF. And in a sense, that's because their business model is different, right? They don't take teams, they take individuals that come with specific roles and skills that they can prove they have because they have a PhD, they have worked at XYZ company. And YC is possibly more open to these wild cards. We don't really know what we're getting type of people and companies that they're coming with. And sometimes that works out and sometimes that doesn't work out. But the openness might be slightly better in YC, which again, I think that's not necessarily a good thing, but given that YC has increased the number of companies it takes in, so I think the quality overall has decreased, that's the problem with it, but that might have made it slightly more open, so it gives chances to people that normally don't have access to the system as such, which is definitely working against bias in the structure as such. And once you have the batch, and I think EF is getting to that point as well, you have the batch of YC or EF, chances are very, very high that you are, because that's the one thing that I think they're doing, really, that you are getting funding. They're helping you to make your slide deck and to make your presentation so that the investors believe in what you're doing, and they're giving you $500,000, $1 million, $1.5 million. At least that round, if you're not totally bullshit, is reasonably secure with both of these accelerators.
Cool. Yeah, I think maybe instead of diving into the second question, just conscious that there's quite a lot of others, so maybe yeah, we just continue around the list.
Yeah. Ryan, you asked, how far does VC appetite for risk go? But relying on a model that requires data and historical precedent, so anything truly new could struggle to raise funds, arguably with an exception for when there's an existing big buzz around the technology. Yeah, risk is a complicated question when it comes to VC, because obviously the whole business model, and again, there's a slight difference between how much risks people are willing to take in the US versus EU. US is slightly more risk embracing, but overall, they all know that statistically speaking, they will make, in their fund of about 8 to 12 years, they will make about if they're not coming with a specific model where they're writing lots and lots of checks, but they will make about 10, 15 investments, possibly 20. And out of these, say 20, because it's easier to calculate, they know that only about 2 to 3 will make them all the money, if they will make money. So they know that a good number of these 20, say 5, 6, 7, 8, within 10 years will be dead. There will not be a company anymore. Then there's a middle graph that will make them their money back, but won't be a fund returner, right? Like say 5, 6, 7, 8, and there will be one that makes a decent amount of money, and perhaps, or 2, and perhaps 1 if they're lucky, possibly 2 that really brings them like the 30, 40, 50, 60, 70, 80 million exit that they need in order to show, look, we returned the fund 2, 3, 4 times, we can raise another fund, right? So in that respect, they know that risk is the one thing that they need to take from the beginning, right? This is how the VC business model is built up. You lose 30, 40% of the companies, and you win with 10, 20% of the companies, everything, right? And you have to find these 10%, and sometimes, and that's where it gets complicated, in the world that we had, at least before COVID, there was so much money in the market that VC started to fight about being let into companies that looked like these outliers, that looked like, and that could be, as you're saying, linked to being in a buzzy environment, right? Suddenly everyone wanted to make an investment in sector X, right? Femtech started to become hip. Not that there's lots of money in there yet, but suddenly every VC said, we need to make a femtech investment. And then some of these companies attracted one big investor, and then everyone wanted in, right? So suddenly there was a race to these, what was seen as the possible fund returner outliers. But in theory, and lots of VCs would say that, and when I asked them about it, any one of the investments that they make, and this is specifically true for America, they need to believe in that investment as being a possible fund returner, right? So they take high amount of risk in every investment because they need to hit this fund returner at least once or twice. So I would say the appetite for risk in VC as a business model, systemically speaking, is very high. And then it depends a little bit on whether you're talking to a German VC, where they're like, I'm happy with doing a 2, 3, 4x incremental innovation startup. They are going into this business model, or they're going into this market, which is big enough. They're helping us to save 10% of cost, 20% of cost. They're quicker. Thinking about a specific example I came across recently that helps you do your taxes. They're not going to be the next Google or Airbnb or Uber or any of that, but they're going to very likely, because the team is solid, they've done this before, they're going to make me a 2, 3x return. That you find much more likely in Europe, continental Europe. UK is somewhere in the middle than you do in the US. And there's one reason for that as well, which is why Europe is still lagging behind in who is in these VCs. So I said that most of these VCs come from specific backgrounds, both in terms of their university education and in terms of their race. Most of them are white, man, and gender. But there's also another thing that's specific to VCs, and where the US is one step ahead, which is that in Europe, most of VCs are still consultants and bankers, or ex-consultants and investment bankers. So their attitude towards risk, qua the system that they were in before, is very different. Because what we're seeing in the US is that we're now at a point where there's so many people with, quote unquote, operating experience, i.e. people that have either started companies before or at least worked in big tech companies, that it's very complicated to argue your way into VC with a banking, or with only, some of these people might still have had tenure in banking, but it's much harder to go from an investment banking job into a VC. We see that lots in Europe. Borderton has just hired their first female partner who came straight from GS, and like 15, 20 years in GS. No idea whether her risk attitude is different from Suranga's, who's another great partner at Borderton, who was an entrepreneur himself, who built his company up to 500 million. I'd argue yes. Also, she doesn't understand the same stuff that Suranga has. So it depends a little bit on the personnel as well. And I think that's one reason why Europe is not as risk embracing as the US is. But again, overall, I think there's lots of risk that these people are willing to take because they have to.
I realize I don't want to take up too long on this question, but I wonder if I should have phrased this differently. Maybe I should have said, do you think maybe there's a certain amount of profiling that goes on in the selection that VCs do on the basis of trying to make decisions that are informed by like clear quantifiable data or historical precedent, or choosing to invest in particular sectors? So if a company wants to try something that doesn't fall clearly under an existing sector, or that there isn't a clear precedent for, but it just requires a kind of experimenting with the marketplace, then they might struggle.
Yeah, and I think interestingly enough, I answered that, but not explicitly, by telling you a little bit about who's who in the difference between America and the US. I think you're right when you hit the consultant or investment banker, right? They are much more insecure going into territory that they don't know, I would argue, than the entrepreneur who's done that before, because they started a company not knowing what they're doing, most likely, right? And I think the consultant is much more, and again, this is the quintessential German VC partner still, the investment banking consultant type. They are more uncomfortable not having data. So I think, yes, it is, and possibly that's also a reason why we don't see these moonshot outliers. We also don't have that many moonshot funds, or they don't have to be called that, but you don't see that many funds that would do these absurd ideas, right? That lots of people explicitly are focused on in the US context. And because there is definitely more of a discomfort with taking these risks where you can't have the data, because this is a new industry, right? I think that's a good point. Absolutely, yeah.
There was actually, I had another question that I think we missed because it's above in the comments. It's whether the system might be to a certain extent self-fulfilling, that companies that don't use VCs might find themselves needing to go to venture capital in order to scale because their competitors are going to venture capital and scaling that way.
Yeah, absolutely. And not only, even if you're in a market that has space for several competitors, right? Which is another thing that VCs often make you think, or VCs think themselves, it's all winners take all. Every market is winners take all, and that's not true, right? There's lots of markets where you have a geographical, there's going to be a winner in the US and a winner in Germany and even another winner in the UK, simply because, say, the regulatory frameworks, if you think about insurance, are so different that it takes so much time that at least you have winners growing up in parallel, so you don't have as much competitive pressure. But even your net or your context, so to speak, right? If you go through EF, obviously you have to raise venture capital, right? If you, and that's what you're told. These are often people that come out of a context where they've never talked about tech company, or they never thought about tech companies before. They're university educated, spent a decade at Imperial researching whatever physics problem, and then they will be told, oh, no, look, you're going to spend these 3 months here, and the one thing that you're going to learn is how to present at the end of these 3 months in front of all of these important white men, that will then give you money, which then allows you to really do what you're supposed to be doing, right? And this is already then kind of structured, this thing that you're supposed to be doing with scale in mind, because you know, as a person teaching these people, that the only thing that VCs invest in is something that's scalable quickly, ultimately, because again, this is what their business model depends on in their LPGP, we have to pay them back structure, right? So yeah, absolutely. There's the whole context as such pushes you, and partly also because we have de-learned that there are alternative ways. And there's a great book that a great mentor of mine, Bill Janeway, has written, who is an are you ever an ex-VC? It's hard to say, but he worked in the early phases of Warburg Pincus when they were still mainly doing VC. They're more prominent for PE now, but he's been in this world for 30 years. And he's written a book called Doing Capitalism in the Innovation Economy. And funnily enough, you would think he's old school and has conservative ideas about everything. But one of these conservative ideas is actually quite progressive in that he says, we've forgotten that the VC industry is not supposed to blow up these companies, then push them into the private market and then disappear with the money or their the rent that they made in the process of helping these companies to grow up and go public and then leave them alone. Really what we should be doing as VCs is help companies to become profitable, right? And Uber, WeWork, if you look through the SoftBank portfolio, there's most companies in there that have not even an idea of how to go there. And he thinks that's very, very toxic. He calls this whole blitz scaling as the norm in VC, as the most responsible thing for the unicorn bubble. That has brought us to a point which was now, interestingly enough, actually shot into by COVID. And it's very hard to now dissect what had which effect. But there's an alternative model that isn't accepted really anymore. And that's where, say, Indie VC, which is run by Bryce Roberts out of Utah, which tells you a lot already, is so interesting, right? Because they say exactly that. We are not, I said that before, we are not here to just help you. Oh, we don't have a goal for you. You set your goal. And I think they are much more likely to help companies just be healthy, right? And often that might mean they're not going to be unicorns that can be IPO'd for several hundred million. Yes, absolutely true. But there are companies that might exist for 20, 30, 40, 50 years, right? And is that better or worse than having a unicorn that dies like WeWork might and Uber might within 10 years of their existence? So what I'm saying is that I think we are slowly rediscovering, possibly at least, there's certain seedlings that there is alternatives to this blitz scaling model, even within the VC frameworks.
Actually, I think that kind of links a bit to my next question, is that we tend to think of ethics in the business space as like linked to legal issues in cases of very obvious harm.
Yeah.
But there's also ethical questions around more kind of humdrum things like pricing and the mechanism of selling. So, for example, like using large amounts of capital to artificially lower prices in an attempt to knock out competitors in the market.
Yeah.
And I guess maybe I'm asking, do you think that the VC, the blitz scaling model encourages that? I mean, in particular, I have Uber's pricing model there in mind.
Well, no, but it would be, there's two examples that immediately come to my mind, which is two of the recent wars, one being the scooter war and the other one being food delivery. And we saw that very, very, and it's in a sense still ongoing. There was a recent sale again, actually. You had these, say, how many was it? 10, 15 local massive food delivery companies, right? And we are now down to, I think, 4. And they were all thrown dozens of millions of VC money at. And they knew they all were, in a sense, geographically slightly separate. There might have been 2 in San Francisco and 2 in Europe, or 3 or 4 in Europe, but there was space, and that's what we're seeing now. There's space for 3 or 4 winners, right? But they were given insane amounts of VC capital to literally spend on marketing and lower the prices, while also pushing through their market power, pushing the actual people that make the food even further out, right? The margins that they get was lowered in that process as well. But it was a game that the VCs fueled 100% in terms of who can, with whatever tactic, and that is where it takes us back to Uber as well, which was trying that, but to eliminate Lyft for ages, right? You take whatever it needs in order to get these people out of the city, right? And here is $1 billion. That's ultimately what SoftBank did. And that's what a lot of VCs on slightly smaller scales did in at least also the, and again, these are just the most prominent examples that came to my mind right now, in the electric scooter wars, that's very much still ongoing, and the food delivery war as well, where the business model was completely undifferentiatable. The only thing that mattered ultimately was who could spend more money on marketing more quickly and deploy that money so that people actually stuck to them rather than a competitor. And whatever tactic was best was allowed, in a sense, right? And I'm absolutely with you when it comes to this is something where VCs, again, have a responsibility, because this is not building a sustainable company in this way that I used the word before. A company that in and of itself is going to be able to freestandingly exist without being pushed up and forward by VC money indefinitely. And then there's these weird movements that we're seeing. Bill Gurley, again, the Benchmark, well, he just resigned from Benchmark, but one of the more prominent VC investors coming out of Silicon Valley, he's a big defender of not going public. So basically keeping these companies private as long as, and that ultimately means fed by VC/investor money as long as possible, because, and there is something about that too. He thinks that the public market is undervaluing some of these companies that are blitzscaled by VCs. It might or might not be true, but it comes with the danger that a company like Uber can do whatever they want. Or, as we've actually seen, the whole WeWork thing just exploded because suddenly people were able to see what was going on internally, right? I think, at least from the public perspective, there's lots to be gotten from communication duties that companies have as soon as they IPO when it comes to doing business correctly, right? Accounting, all of these practices that Adam Neumann was involved in, selling his brand that he came up with back to the company. That could be avoided if there was even more VC money available to keep these companies private even longer, right? And I think that's dangerous as well.
Mm-hmm. Actually, I would like to follow up with the question that I was going to mention before, so specifically related to regulation. Mm-hmm. So, I mean, in the context of regulation, I mean, there's quite a lot of dimensions that the conversation could go. You know, it could be regulation in the context of limiting VCs, you know, I guess specifically to avoid some of the malpractices and perhaps, you know, feeding in to, you know, development of companies that could perhaps be performing sort of unethical developments. I mean, arguably something like Cambridge Analytica would not have been possible without the upfront funding. But I think the perspective that I'd be interested to explore further in regards to regulation is more on the, I guess, slightly seeing the VC side from a more positive perspective. I guess specifically in regards to now, with so many countries facing requirements and demands towards meeting sort of innovation in regards to being able to keep themselves competitive, right, against even other nations. And right now we're seeing it, you know, East versus West, and just, you know, generally like across the entire world. So from a regulatory standpoint, how do you see public bodies interacting with not only the VC industry, but VC's techniques? Do you see government investment schemes, for example, potentially having a lot of benefit from trying to jump into the wagon and try to fund some of these innovative companies? Or do you think that what they need to do perhaps is more of just backing the industry in itself within their sort of country? So what is your perspective in that interplay between national interests and sort of, you know, VC as a whole? Yeah.
I'll share a piece I wrote about bailout funds recently. Bailout funds for startups, so basically support for VCs. And why is that interesting? I'm going back to your question. So I think that one straightforward answer in terms of regulation of VCs, I think that's not going to happen. They're too small. I mean, and that's why there's so little focus on this group also from an academic perspective. Their numbers are too tiny, there's too few of them. It's not worthwhile regulating that specific group. What might be more regulated, say, and this is me completely just thinking aloud, is investors as a whole. You might have to have an ESG rating for your fund or something, right? But there's not going to be anything just for VCs, I believe, because the group is too small and ultimately also, interestingly enough, very powerful. You're reasonably likely to have lots and lots and lots of VC billionaires. That actually happened recently again in the US, campaigning for a tax cut for, because and that's also different, funnily enough, between a PE and a VC, because these VCs often directly, personally own equity. So they campaigned and were granted a tax cut for payments on these, for profit payments on these equities. So I'd say they're very powerful, politically speaking as well, at least in the US. That's slightly different here. But again, even more importantly, I think they're reasonably unimportant for the government. I think the government is more looking at investors, and that would include, I mean, a group that was very, very heavily regulated until the 70s, the pension funds. They have much, and we're talking multiples of capital available than the VC. So I don't expect there's any kind of direct regulation going to happen to curb VCs. What I think is much more likely is that they're going to go for the tech companies, and that's ultimately directly, not even just indirectly, directly affecting the companies that VCs will want to back, because if they know, look, they're running into this and this problem here, regulatorily, they can't scale as much, i.e. they can't make as much money, right? So there's one route in here that I'm seeing where the government will affect VCs' decision-making because they're affecting that, possibly at least. We haven't really seen too much of that yet, but it's more likely that they're regulating tech companies. And that will, again, first and foremost be about big tech, but lots of these rules will then also apply to the next big tech, right? Google wasn't big tech 15 years ago, they were just a startup. So as the government learns, I think that's where they're going to start cutting and regulating. But your point about the government being an actor in this world is actually highly interesting. I don't know how familiar you are with Mariana Mazzucato's work. In her book, The Value of Everything, she has a chapter where she goes after VCs in a very straightforward, in a sense, but quite tainted critique. I'm fully with her when it comes to her earlier argument about the entrepreneurial state. And that's, again, what some VCs in their hubris forget sometimes, that they're only really, I always think about it as kind of an iceberg logic. The state has to fund basically the whole iceberg in terms of basic research, universities, all of these technology innovations, and the iPhone is what I think always is drawn on here. All of the different components of the iPhone were funded by government money in one or the other way in the US. Different government agencies, different grants, different developments that led ultimately to Apple being able to just pick these different components and put them together. And what the VC is very good at is not the iceberg. The iceberg is way too big. The iceberg is like trillions of dollars in a specific technology, and that specific one was semiconductors, and then the next one, which brought us all the apps, was the internet, basically, and the iPhone, one of the bits that connected the dots. But what VCs are good at is the last 5%. They do this commercialization that universities are very shit at, right? And that's why I don't agree with Mazzucato. She doesn't think that they're good at that too. She thinks they're reaping way too much benefit, and that might be right as well, for doing these last 5%, and nobody talks about the 95% that the government mostly financed before that, right? And what I argued in that piece, and what I'm actually just proposing a research project on, to compare the bailout funds as they are now in existence between Germany and the UK, is why doesn't the government at least have one finger, not even an arm, one finger into that, in that last 5% bracket in and of itself, right? Why doesn't the government hire a bunch of great VCs, put a couple of billion on the line, and invest directly in startups? The German government does that quasi. There's a fund there called the High-Tech Gründerfonds, which is in most quite focused on deep university-driven tech. But in most German startups, they're invested with small tickets, but they do know what's going on. They see how the innovation landscape is developing. Sometimes I think they also take board seats, so they can, in a sense, influence how the company is moving, and they at least have transparency, certain transparency about what these companies are doing. And I think that could be done much more. Why doesn't the Future Fund, as it is set up at the moment, which has another big flaw, which is what I'm proposing to investigate, because it's highly inequitable, as it doesn't give money to people that haven't raised money before. So again, it's just a reproductive technique for the system to kind of sustain itself, which the German government, again, did much better. They have a second pillar to their fund, just focused just on companies that haven't gotten any money. But why doesn't the Future Fund go one level further and say, look, we actually want to do this with proper equity investments where we also take board seats, for instance, right? That is something where beyond just regulation of a sector or industry, why don't you just be an actor in it, and by being among them, figure out what's going on much better.
Awesome. Oh, that's really, really insightful. Okay, well, I mean, we're getting to the top of the hour and a half. And
yeah,
I guess just for the last few minutes, I mean, Johannes, do you have anything that you want to give a shout out on, or for where people can actually check out your work before sort of wrapping up? Mm-hmm.
Yeah, so what I'm trying to do is be as present as possible, even more so in the regular outlets that people would read. So I'm in the process of writing for 2 or 3 of the bigger magazines at the moment, and I think you'll see me again and again pushing this agenda of we need to follow the money. These 2 magazines saying, forget AI ethics, we need to talk about VC ethics because they're making AI. And again, I know that this is very polemical, but I think that agenda is very much something I want to take further into the public conversation. And I hope to see as many of you as possible in these different realms, and possibly also meet in person at one point in the future again.
Awesome. Yeah. Hopefully, we'll have the face-to-face ones. But yeah, Johannes, thank you so much.